Let me ask you something. How does the richest country on Earth owe over $36 trillion? Like seriously, the US prints the world's most powerful currency, collects trillions in taxes every year, and yet somehow, it's drowning in debt. So, how do we get here? And more importantly, what does that mean for you, me, and everyone living under the stars and stripes? Let us break down the unbelievable story of how America built its trillion-dollar debt mountain, step by step, and why that number keeps exploding. Before we dive into history and drama, let's clear one thing up. What is national debt, really? Imagine you make $5,000 a month but spend $6,000, that $1,000 gap? You borrow it from friends, credit cards, or a loan. Now multiply that by millions of people and add a few zeros. That's what the US government does every year. Whenever it spends more than it earns from taxes, it runs a budget deficit. To fill the gap, it borrows money by selling treasury bills, notes, and bonds to investors around the world. These investors can be US citizens, big banks, pension funds, even foreign governments like China and Japan. Over time, all those borrowed amounts add up, forming what's called the national debt. So the national debt is basically the sum of all past deficits. Every time the government couldn't cover its bills, it added a little more to the pile. Right now, that pile is roughly $36 trillion, or about $106,000 per person in America. The story of American debt starts literally with the birth of the nation. When the US fought the Revolutionary War in the late 1700s, it had to borrow millions to fund the army and supplies. That was the first taste of debt. Then came the Civil War, when the US debt shot from just $65 million to $3 billion. War is expensive, and war debt became a pattern. Fast forward to World War II, the real explosion point. In 1940, the US owed around $51 billion. By the end of the war, $260 billion. That's a 5 times jump, but the country was rebuilding the world, so no one complained much. After World War II, the US economy boomed, debt shrank as a share of GDP, and everyone thought, okay, problem solved. Spoiler alert, it wasn't. The 1980s changed everything. Enter President Ronald Reagan. Tax cuts, Cold War defense spending, and a love for economic growth through lower taxes. Between 1980 and 1990, US debt more than tripled, from under $1 trillion to over $3 trillion. By the 2000s, wars in Iraq and Afghanistan, tax cuts under President Bush, and then the 2008 financial crisis piled on even more. Then came 2020, the pandemic. The government printed and spent trillions to keep the economy alive. Stimulus checks, business relief, unemployment benefits. It worked in the short run, but added fuel to the debt fire. Now, in 2025, the US owes over $36 trillion. To put that in perspective, if you started counting $1 per second, it would take you over 1,000,000 years to reach 36 trillion. So why does this number keep climbing? Because of 6 powerful engines driving the debt. Persistent deficits. The US has run deficits almost every year since 2001. Even in good times, it spends more than it earns. Tax cuts equals less income. Every time the government cuts taxes from Reagan to Trump, revenues drop, but spending rarely does. High spending. The US spends more on defense than the next 10 countries combined, plus massive entitlement programs like Social Security and Medicare that grow automatically. Crises equals emergency spending. Recessions, wars, and pandemics all trigger huge spending sprees. Rising interest costs. As debt grows, so do interest payments. Billions every month just to stay afloat. Political gridlock. Cutting spending or raising taxes is political suicide. So Congress usually kicks the can down the road. A lot of people think China owns all our debt. Not exactly. About 2/3 of US debt is owned by Americans themselves, through pension funds, insurance companies, and banks. Roughly 1/3 is owned by foreign investors, mainly Japan and China. So when we talk about the US owing trillions, it's not just to other countries, it's also the US owing itself. But that doesn't make it harmless. Interest still has to be paid, whether to foreign creditors or domestic ones. Let us look at how fast the debt is growing. 1980 under $1 trillion. 1993 $1 trillion. 2000 $5 trillion. 2010 $13 trillion. 2020 $27 trillion. 2025 $36 trillion. That's a 36 times increase in 45 years. Debt as a share of the economy (GDP) is around 120%, meaning the US owes more than it produces in a year. With higher interest rates, it's costing more and more just to keep up. So why not just print the money? Well, if the US prints dollars to pay its debt, it floods the economy with money, making every dollar worth less. That's inflation. And once inflation spirals, it hits everything: groceries, gas, rent. The US tried a version of this during COVID stimulus, and we all saw prices skyrocket. So yeah, printing money isn't a magic fix. It's like taking painkillers instead of curing the disease. At this point, the national debt isn't just numbers. It's a living, growing force shaping America's future. And we're just getting started in the next part. We'll dive into how this massive debt actually affects the US economy, your wallet, and the global balance of power. Oh, and before we move on, if you're re-enjoying this deep dive and love breaking down big financial stories like this, make sure you hit that subscribe button for more from Assets Amplify. Because trust me, the next half of this story will change how you see money forever. So now that we've unpacked how the United States ended up with more than $36 trillion in debt, the real question is, what does that actually mean? Because this number isn't just sitting on a spreadsheet somewhere in Washington. It affects every corner of the economy, from the price of milk to the rate on your mortgage, from the strength of the dollar to America's power around the world. Let's break down exactly how the national debt impacts the country, its citizens, and its future. First, let's start with the obvious one: economic growth. When a government owes as much as the US does, a huge portion of its budget goes just to paying interest. That's money that could have gone into building infrastructure, improving education, or investing in innovation. Economists call this the crowding out effect. Every dollar the government borrows is a dollar the private sector can use for business expansion or job creation. Over time, that slows productivity, and slower productivity means lower growth, fewer opportunities, and smaller wage increases. When you think about how the US used to invest heavily in highways, research, and space exploration, but now spends hundreds of billions each year on debt interest alone, you can see the trade-off happening in real time. The second effect is interest cost pressure. Interest payments are not optional. They're the minimum payment on the world's biggest credit card. As interest rates rise, those payments climb fast. Just a 1% increase in average interest rates can add hundreds of billions of dollars to annual costs. That means that even if the government froze all other spending, the debt would still grow simply from interest piling up. This dynamic makes balancing the budget extremely hard, because before the US can fund any new priority, it has to pay its lenders first. And the lenders? They expect every cent on time. Next comes flexibility, or the lack of it. When a country carries this much debt, it loses room to maneuver in emergencies. Think about 2008 or 2020. In both cases, the government had to borrow trillions overnight to prevent total collapse. Those actions were necessary, but they also show how little cushion remains. If another major crisis hit today, a financial meltdown, a pandemic, or a global conflict, the US might find itself with fewer tools to respond. The debt is like an anchor on a ship that's constantly trying to sail forward. Now let's talk about taxes and spending trade-offs. Every generation of politicians faces the same impossible equation: either raise taxes, cut spending, or keep borrowing. Raising taxes is unpopular. Cutting Social Security, Medicare, or defense is even more unpopular. So what usually happens? They borrow more. But there's a limit to how long that can continue before markets lose confidence. Eventually, the math forces action, meaning higher taxes or reduced government benefits down the road. That's the intergenerational cost of today's decisions. And speaking of generations, let's make that the next point: the burden on future Americans. National debt doesn't disappear. It simply transfers forward. Future taxpayers will be the ones footing the bill for today's spending. That could mean higher income taxes for workers who haven't even entered the job market yet, or fewer public services because more of the budget is devoted to debt service. Imagine inheriting a family business where most of the profits go toward paying off your parents' credit card. That is essentially what young Americans are facing. Another crucial effect is inflation and monetary pressure. While the United States has the unique privilege of issuing the world's reserve currency, that power has limits. If investors ever doubt the government's ability to manage its finances, they'll demand higher yields on treasury bonds, and that filters down to higher interest rates everywhere. Mortgages, auto loans, credit cards, and business borrowing. Those higher rates make everything more expensive and can slow the economy. Meanwhile, if the government were ever tempted to print its way out of trouble, that would trigger inflation, eroding purchasing power, and making life harder for ordinary people. The last few years of elevated prices were a taste of how sensitive the system is. Now let's address the global angle. U.S. debt is deeply tied to America's global power. Investors all over the world treat U.S. treasuries as the safest asset on earth. That trust gives the dollar its reserve currency status and lets the U.S. borrow at low cost. But that trust isn't unconditional. If debt keeps climbing without a credible plan to stabilize it, foreign governments and investors could start to look elsewhere. A loss of confidence in treasuries would shake global markets, raise borrowing costs, and reduce America's financial influence. Think of it this way: U.S. debt is not just an economic issue, it's a pillar of global stability. There's also the credit rating risk. Ratings agencies like Moody's and Fitch evaluate how likely a country is to repay its debt. When they downgrade U.S. credit, as they have done in the past, it is a warning sign to investors that the country's fiscal management is slipping. Each downgrade means higher interest rates and more skepticism from financial markets. It also affects everything from corporate borrowing to consumer loans because the treasury market sets the benchmark for global finance. For ordinary citizens, all this might sound distant, but here's where it gets personal. The national debt can affect your life in direct ways. Higher federal borrowing can push up interest rates, making mortgages and student loans more expensive. If inflation rises because of excessive government spending, your paycheck buys less. And when a larger slice of the national budget goes to interest payments, programs like healthcare, education, or infrastructure receive less funding. It's an invisible tax. You don't see it deducted from your income, but you feel it in slower growth, weaker public services, and a less stable economy. Now, some people argue that debt doesn't matter because we owe it to ourselves. There's truth in that. A lot of U.S. debt is held by American institutions. But that logic misses something important. Whether the debt is owned by citizens or foreign investors, the government still has to pay interest, and that money comes from taxpayers. The difference is just who collects the payment. When debt rises faster than income, even internal borrowing becomes a drag on the economy. Let's look at some scale comparisons. In 1980, the national debt was less than $1 trillion. By 2000, it was $5 trillion. After the 2008 financial crisis, it hit $13 trillion. Then after the pandemic, it jumped past $27 trillion. As of 2025, it's over $36 trillion and still rising. In terms of GDP, that's about 120%, meaning the country owes more than it produces in an entire year. Historically, high debt-GDP ratios limit growth potential and make recessions harder to fight. So what can be done about it? The options are simple in theory but brutal in practice. The first path is fiscal consolidation, either increasing revenue through taxes or reducing spending through reforms. This could mean re-evaluating entitlement programs, closing tax loopholes, or reprioritizing government investments. The second path is growth-driven stabilization, focusing on policies that boost GDP faster than debt grows. Stronger economic growth naturally improves the debt-to-GDP ratio, making the burden easier to handle. The third path is structural reform, improving efficiency in healthcare, updating tax systems, and modernizing how the government manages its obligations. The final path, though less discussed, is debt management, extending repayment timelines, securing low-interest borrowing, and avoiding new unfunded commitments. None of these are easy, but the longer policymakers wait, the harsher the adjustment becomes. Another angle worth considering is public perception and political accountability. As long as voters reward politicians for promising benefits without paying for them, debt will keep growing. Fiscal responsibility rarely wins elections because the pain of cuts or tax hikes is immediate, while the reward, stability, is long-term. Changing that mindset may be the hardest reform of all. Now let's imagine two possible futures. In one, the U.S. takes early action, gradually raising revenue, moderating spending, and letting the economy grow into its balance sheet. The adjustment is slow but steady, and confidence in the dollar remains strong. In the other, the U.S. keeps ignoring the warnings. Debt continues to rise faster than GDP, interest payments consume larger portions of the budget, and investors start demanding higher yields. That spiral could lead to slower growth, higher inflation, and a painful reckoning. The outcome depends entirely on the choices made in the next decade. To be clear, not all debt is bad. Borrowing to invest in infrastructure, research, or education can generate returns that outweigh the cost. The danger lies in borrowing for consumption, spending that provides no future payoff. Right now, much of the US debt supports existing programs rather than productive investment. If that balance doesn't shift, the country risks trading long-term prosperity for short-term comfort. At the personal level, this discussion matters because national finance and household finance share the same principle: sustainability. If you live beyond your means for too long, interest payments start to control your life. The US is approaching that point on a national scale. Recognizing it now is the first step toward fixing it. So what can ordinary people take away from all this? For one, awareness. When you hear debates about the debt ceiling, spending bills, or tax reform, they not abstract fights, they arguments about the nation's future financial health. Second, pressure your leaders to think long-term. Deficits don't vanish by themselves, and waiting until the crisis hits always costs more. Finally, remember that economic literacy is power. The more citizens understand how debt works, the harder it becomes for anyone to ignore it. In summary, the national debt is not a doomsday sentence, but it is a flashing warning light. It affects growth, limits flexibility, risks inflation, and passes costs to future generations. It can weaken America's global position and strain the everyday finances of its citizens. But it can also be managed if policymakers and the public treat it seriously. The United States has faced bigger challenges before and emerged stronger. The same can happen here, but only if discipline replaces denial. If you found this breakdown helpful and want to understand more about how global economics shapes everyday life, stay tuned for more on Assets Amplify. In upcoming videos, we'll dive deeper into how national debt influences inflation, interest rates, and even your personal investments. Understanding money isn't just for economists. It is for everyone who wants to protect their future.